Hello and welcome to my finance teacher. I hope you guys are having a nice day. And we are looking at S&P 500 at the moment. This is the daily chart in front of you. Well, of course, as you know, for the last couple of weeks, there's been a lot of pain in the stock markets. And what I want to tell you in this video is, in my opinion, this pain is about to finish. And this intermediate decline in the S&P 500 is about to finish as well. Now let me present you my reasoning for that. First of all, what I see on the chart is that this decline has already given us three legs, 1, 2, 3, and the declines usually have multiple legs. And I don't think that this decline is going to continue for that much longer. We still might have several days within this decline. Let's put the Fibonacci numbers on the chart. We see that the decline has already passed through the 62% retracement. And the next significant number on the Fibonacci line here is the 78% retracement, which is not that far from where the S&P 500 is at the moment. So if this decline continues for just another several days, we might reach this resistance at, support at about 78% retracement. And that might actually also mean that these May lows might hold over the next, as I said, a few days. Another thing I want to draw your attention to on the chart is this positive divergence between the price action and RSI. RSI has not confirmed the lower lows, which, as we know, is a positive divergence, which is one of the indicators that the low is coming pretty soon and the price might revert and start increasing relatively soon as well. So I would actually become quite interested in triple Qs, in QQQ, once S&P breaks above this trend line. This is the trend line that we have established during this declining phase of the intermediate cycle. And if the new cycle is starting, then that trend line is going to be broken. Once that's broken, meaning that if the S&P is above, say, 2730 or so, I might put some money into triple Qs. Another thing I want to draw your attention to is that recently RSI has been more oversold than it was even during this relatively scary drop in February this year. And we've seen that after that, price has actually recovered quite well. Now we've seen that RSI has actually reached deeper into oversold territory. The price is also stretched further below the 100-day moving average. The 50-day moving average is still above the 100-day moving average, even though it's starting to decline. We've actually seen this earlier this year as well. Even though 50-day moving average crossed below 100-day moving average in around mid-April, price did manage to recover pretty well since then. And now I want to draw your attention to this longer-term chart. This is a weekly chart going back all the way to this relatively scary drop again in late 2015, early 2016. What I want to mention on this chart is whenever this short-term RSI, that's only 5-week RSI, has reached or has touched the oversold levels, that was generally good time to enter the markets. So that was the case over here in June, October 2016, April and August 2017, earlier this year, and that might most likely be the case relatively soon, around nowadays. And lastly, another thing I want you guys to have a look at is this forecast for the Fed rate hike in mid-December. So current rate is at 200 basis points. And what we see here is market expects that the rate will be hiked with about 69% probability. But what's interesting? What's interesting is the rate of change of the expectations. If you have a look at this, only about a week ago, the market was of the opinion that the Fed funds rate is going to stay where it is with less than 20% probability, whereas nowadays the market thinks that the Fed funds rate might actually stay where it is with more than 25% probability. So market is gradually shifting its opinion about the likelihood of this rate hike. The likelihood is declining, the likelihood of the rate hike. And that might actually translate into nice gains in a lot of different assets. Once a greater number of market participants notices that the expectation for the Fed rate hike is not as high anymore, that might be very, very positive for a lot of different assets, including, of course, S&P 500. And another important thing is if this expectation of a Fed rate hike drops deep enough, drops low enough, the Fed might actually decide not to hike the rates in order not to hurt the markets. Of course, Powell seems to be a little bit more hawkish in that respect compared to Yellen. Nevertheless, if Fed rate hike is not really expected by the markets, the Fed might not give it to the market in order not to create an unexpected collapse in many asset prices. So that is my opinion on the markets. In summary, probably a decline over the next several days again, followed by a new advancing phase of a new intermediate cycle. Of course, there will be declines at some key resistance levels, for example, somewhere around the top at mid-April and around the May and June bottoms. All of those sort of align into one support resistance zone. But generally going into the Christmas holidays, that's usually a good time for the markets. I expect a rise in the S&P 500. Let me know what do you guys think. I do appreciate your comments. Hit the like under the video if you think it's kind of interesting or maybe even a little bit useful, and subscribe to the channel if you haven't.